inheritance tax is charged on a transfer of value. There must be a transfer of value of chargeable property, that it will not be an exempt one, and by a chargeable person. Now, what do you mean by transfer of value? Transfer of value means gift of asset that results in reduction in the value of the donor's estate. So transfer of value means any reduction in the value of donor's estate, and it must be a gift. So if you have to calculate transfer of value, then value of estate before gift minus value of estate after gift, and the resulting difference is the transfer of value, that is the fall in the value or transfer of value. Now, what is considered to be a chargeable property? Chargeable property is anything that is not considered as an exempt asset. And now let's discuss who is a chargeable person that is eligible to pay IHT. For TX purpose, all individuals are potentially liable for IHT. Now, if an individual is domiciled in UK, he or she is liable for IHT on worldwide assets, any transfer of assets worldwide. But if not UK domicile, then IHT on only UK assets. So in this way, we can say that an individual usually pay IHT on transfer of value when it becomes chargeable. Now, IHT is usually payable on gifts, so the gifts can be classified as potentially exempt transfer that is PET, PET, or chargeable lifetime transfer, that is CLT. Now, what is the difference between a potentially exempt transfer and a chargeable lifetime transfer? So, for TX purpose, a potentially exempt transfer is gift to any family members, friends, etc., etc. And for chargeable lifetime transfer, this is gift to trust. So if any gift is other than trust, then it's considered as a potentially exempt transfer. Now let's discuss what is a potentially exempt transfer. Potentially exempt transfer might be completely exempt or taxable. It might be exempt at the time of gift. But there are two circumstances. If donor die within 7 years of transfer, then it's become taxable. Otherwise, completely exempt. That's why it's called potentially exempt transfer. So it means that when a gift has been made, at the time of gift, there will be no tax. But if donor dies within 7 years of the transfer of gift, then this PAT becomes taxable, and the tax is to be paid by the person who received the gift. Now let's discuss what is CLT. If the gift constitutes CLT, then at the time of transfer, it's partially taxable, and tax is to be paid by either donor or donee. It is the responsibility primarily of donor to pay tax, but you have to check in the question that whether the taxable person is donor or the donee. And as far as on death, if donor died within 7 years of transfer of debt, then further tax is to be paid. But if donor dies after 7 years of transfer, then no further tax. So that means that in case of CLT, when we are giving gift to a trust, it is partially taxable at the time of transfer, and the final tax liability depends on the 7 years rule. Now, at the time of transfer, if donor has to pay tax, then that gift is considered as a net gift. And the tax rate would be 25%. And if donee pay tax, then gift is a gross gift, and the tax rate is considered to be 20%. Before moving to the computation of lifetime tax, let's discuss how much exemptions and relief available on transfer of value. There are two types of exemptions. One lifetime and other is on death. As far as lifetime exemptions are concerned, this is a small gift exemption. Another one is marriage exemptions, normal expenditure out of income, and then annual exemption. These all are available for PET, but only annual exemption is available for CLT. And also remember that the on death only inter-spouse transfer is exempt. Similarly, during lifetime, if there is any gift made to husband and wife, from husband to wife and from wife to husband, the inter-spouse transfer is exempt both during lifetime and at the time of death. Now let's discuss these exemptions in detail. So first of all, the small gift exemption. Lifetime gift is exempt if they are outright gift to an individual of no more than £250 per person per tax year. So that means that if a gift of 350 was made to an individual, then small gift exemption is not applicable. An entire gift is taxable. As far as the marriage exemption is concerned, actual marriage must take place in order to get this exemption. Gift of 5,000 by a parent is exempt. 2,500 by grandparent or remote ancestors Similarly, up to by party to marriage, that is bride to groom or groom to bride, and 1,000 by anyone else. So if 5,000 or more than is given by parent to son or daughter, then up to 5,000 is exempt. Similarly, 2,500 by grandparent or remote ancestors, and 2,500 by party to marriage from bride to groom or groom to bride, and similarly 1,000 by anyone else. Now, as far as the normal expenditure out of income is concerned, normal expenditure out of income. So what it means? It's a routine type of expenditure. For example, parents are meeting the living expenditure of their kids. It also does not affect the donor's standard of living. To be treated as normal, gift is habitual. For example, a normal payment of fee of college, normal expenditure on food items, clothes, etc., etc. Another is annual expenditure, annual exemption. An annual exemption of £3,000 in any tax year is exempt, and if there are two or more gifts in a tax year, then is applied on first gift, then on second gift, and so on. Irrespective of whether first gift is PET or CLT, it is always applied first on first gift. If there is any unused annual exemption, it can be carried forward up to 1 year, but can be used after current year annual exemption. So if there is no gift in a previous year, then annual exemption for current year is 6,000. One for the current year and one that is carried forward from the previous year. When we apply exemption, then other exemption must be applied first. An annual exemption is to be applied at the end of all exemptions, because if it is unused, then it can be carried forward to the next year. Now let's discuss the tax on CLT, that is lifetime tax on CLT. Now, in order to calculate tax on CLT, first of all, we will identify any transfer of value. Say suppose the transfer of value is 400,000 pounds. Now, from that transfer of value, we will deduct an amount that is called annual exemption. As you know, no other exemption is available. So annual exemption of current year 3,000, and if not used, then annual exemption of the previous year. Now that becomes 3,94,000, and this is called the chargeable amount. Now, this chargeable amount might be a gross chargeable amount, or it might be a net chargeable amount. It depends on who is paying the tax on CLT. If trust is paying tax, then it's a gross amount. If donor is paying tax, then it's a net amount. Now, from this chargeable amount, we have to deduct nil rate band, that is NRB, and that NRB will be available in the question, assuming the NRB is for this tax year is 300,000, so the leftover amount is 94,000. So it means that if the chargeable amount or the gross chargeable amount is greater than nil rate band, then excess amount is taxable. And who has to pay tax? Either donor has to pay tax or the trust has to pay tax on this amount. Now let's see how much tax rate is there and how we can calculate tax liability. So this is the taxable amount. Now the IHT rate is either 25% or 20%. That depends on who is paying tax, either donor or trust. For example, Mr. C makes a gift of 366,000 to a trust on 30 June 2018. There is no previous gift made by Mr. C. That means this is the first time gift to any trust. Calculate IHT on lifetime transfer, assuming donee has to pay tax and assuming donor has to pay tax. That means I have to solve this with first donee's point of view and then from donor's point of view. So let's work it out. So transfer of value. Now, assuming donee has to pay tax. So let's write it down. It is a CLT and the date is 1306-2018, and we have transfer of value. That transfer of value is 366,000. Now, the first thing is there any annual exemption? Yes, there is an annual exemption, and that annual exemption is 1819, that is the current year first, and then 1718 as there is no previous year. So we have last year's annual exemption to be carried forward. Now, if we deduct this amount, then we will get an amount of 3,60,000. Now, who is paying the tax? That is Dhoni. So I can write it down. This is gross chargeable amount. So we have gross chargeable amount of 3,60,000. Now, we have to deduct the NRB, and NRB of 1819 will be provided you in text sheet, and if the year is different, then it will be given you in the question. So for 1819, the NRB is 3,25,000. So the gross chargeable amount is in excess of NRB, and the leftover amount is 35,000. So this is the taxable amount, and on this taxable amount we have to pay IHT, and what would be the rate? At the rate of 20%. Why 20%? Because Dhoni is paying tax. Now 20% of this is 7,000. 7,000 is the inheritance tax payable, and is to be paid by Dhoni. Now after identifying this, identify what is gross chargeable amount, and the gross chargeable amount is 3,60,000. Now let's calculate from the perspective of donor. Again, CLT, the date. Now let's find it out. The transfer of value, that is 3,66,000. Similarly, the annual exemption of 1819 first, then 1718, again 3,000. Now this is 3,60,000. Now, as donor is paying tax, so now this is considered as net chargeable amount. Now we have to deduct nil rate band, and that is available 3,25,000. Now we have the same value, that is 35,000, the taxable amount. Now IHT is 25%, because donor is paying tax, so the tax rate becomes 25%, and that is 8,750. So IHT payable is 8,750, and now the gross chargeable amount becomes the net chargeable amount above plus 8,750. So net chargeable amount plus IHT payable, and the total is gross chargeable amount, and that is 368,750. We have to use this gross chargeable amount at the time of death of the donor. Now let's discuss the 7 years accumulation rule. This is related to the calculation of NRB, whether we can use NRB from the chargeable amount or not. As we know that in a tax year, when we transfer something, we used to deduct nil rate band, but we have to compare the nil rate band of the transfer that whether it is available or not. So each time when a CLT is made, look back 7 years from the date of the gift. Remember, from the date of gift. What you have to check from the previous 7 years? We have to check that is there any gross chargeable amount in previous 7 years? If this is the case, then we can say NRB is used up against this gross chargeable amount. For example, a CLT was made in 2012, and similarly a CLT is made in 2016. There was a gross chargeable amount of 1,50,000. Now, when I'm calculating CLT, tax on CLT on this gift, then assuming NRV is 300,000, but I have to look back 7 years. And now in this case, from previous 7 years, within previous 7 years, there is a CLT and there is a gross chargeable amount of 150. So we can say that the NRB is used up by 1,50,000 and the remaining NRB is now 1,50,000 that can be used in CLT calculation. So whenever we have to calculate tax on CLT, we have to look back 7 years from the date of transfer, and you have to check that whether there is any CLT. If there is any CLT, then identify the gross chargeable amount of the last 7 years. If there are more than one gift, then add up all the gross chargeable amount. For example, from look back 7 years, the gross chargeable amount is 400,000. And NRB is 3,25,000. So that means NRB is completely utilized. So in our calculation, the NRB becomes 0. So that 7-year accumulation rule is very important. Always consider the 7-year accumulation rule when you have to calculate inheritance tax on a lifetime transfer, that is CLT.